Ethan, would you suggest the Job Guide 360 guide for candidates getting ready for interviews?
Yes, without a doubt. It is well structured and makes preparation straightforward.
Welcome to the Deep Dive, your shortcut to knowledge. We sift through dense sources to pull out the high-value insights you need fast.
That's the plan.
Today, we are tackling a big one, cracking the code on asset management fundamentals. We're using the kind of core concepts, the professional knowledge, that really define expertise in this field.
Exactly. We're not just reading definitions here. We've got a stack of sources, articles, papers, industry guides.
Right.
And we're using them to, understand the real architecture of managing portfolios.
Yeah.
Thinking about market analysis, risk management.
And those investment strategies that actually, hopefully, make money for you.
That turn theory into results. Yeah, that's the goal.
So let's jump right in. The absolute core. What is asset management? Forget the long textbook answer. What is it really?
At its heart, asset management is strategic stewardship of wealth. Simple as that.
Okay.
It's a systematic, long-term process, managing financial assets for a client or an institution. And the explicit goal is always maximizing returns, but, and this is crucial, within a defined risk profile. It's active decision-making, not just admin.
And that decision-making engine relies on, what, 3 key parts?
3 inseparable components, really. You need rigorous market analysis, stringent risk control, and disciplined investment strategies.
Can't have one without the others.
No, they work together.
Okay, let's unpack the first sort of philosophical choice an asset manager makes. Active versus passive. This is huge.
Oh, absolutely huge. For decades, active was king, but the shift towards passive has been massive lately.
So what's the fundamental difference driving that change?
It really boils down to effort and, I guess, aspiration. Active AM is very hands-on. Managers are constantly trading, buying, selling. They're explicitly trying to beat a benchmark like the S&P 500.
Wait, outperform the market.
Exactly. They're chasing alpha, that extra return. But all that research, that trading, it costs money. So active funds generally have higher fees.
So you're paying for the promise, the potential of beating the average.
Precisely. Now, passive AM is, well, it's the total opposite. It's a lower cost, long-term strategy.
Much simpler.
Much simpler in concept. The goal is just to replicate the performance of a market index.
Like buying the whole index.
Pretty much. You aim to match the market return, minimize effort, and crucially, minimize those fees.
And that fee difference is a big part of the shift.
It's a massive part. Over the long haul, it's actually really hard for most active managers to consistently beat the market after you account for their higher fees, especially in efficient markets.
Makes sense. Okay, so when you're building a portfolio, active or passive, you need building blocks. What are the main asset classes?
The foundational ones, the big 4, are usually equities, that's stocks.
Right.
Fixed income bonds, real estate. And commodities like oil or gold.
And why mix them? Why not just pick the best one?
Because they behave differently. Each class has its own risk and reward profile. Equities offer growth potential, but are volatile.
Higher risk, higher potential reward.
Typically, yes. Fixed income is generally more about stability and income. Real estate can provide income and hedge against inflation. Commodities are different again.
So mixing them smooths things out.
Exactly. By combining these unique characteristics, you achieve diversification, spreading the risk. It's essential for stabilizing your returns over time.
Got it. Now, speaking of structures, let's talk vehicles. Mutual funds versus ETFs, exchange-traded funds. People hear these all the time. What's the real difference for you, the investor or manager?
Well, the basic mechanical difference is how they trade. A mutual fund prices just once a day at the end of the day based on its net asset value, or NAV. An ETF, on the other hand, trades all day long on an exchange, just like a regular stock.
So more flexibility with ETFs.
Definitely more trading flexibility. But the deeper insight often comes down to things like tax efficiency and structural transparency.
How so?
ETFs, because of the way new shares are created and redeemed in kind, tend to be more tax efficient, especially in taxable accounts. They often avoid distributing large capital gains. Okay. Less tax drag.
Potentially, yes.
Yeah.
So they're often preferred for passive strategies and buy and hold investors. Plus, that instant trading flexibility is something mutual funds just can't offer.
Right, so we have the structures. Now, how do we measure success? It's not just about making money, right? It's about risk-adjusted returns.
Absolutely crucial distinction. Raw return is easy to see, but meaningless without context. How much risk did you take to get that return?
So first, how do you manage that risk? Diversification is the baseline, you said.
Diversification is step one. It helps protect you from unsystematic risk, the risk tied to a specific company going bust, for example.
Right, don't put all eggs in one basket.
Exactly. But what happens when the whole market tanks? Diversification across stocks won't save you much then. That's systematic risk.
So what else do managers use?
They use more quantitative tools, things like scenario analysis and stress testing.
What does that involve?
It means modeling what-if scenarios.
Yeah.
What if interest rates suddenly spike? What if there's a recession? What if oil prices double overnight?
You run these extreme but plausible scenarios against your current portfolio to see how badly it might perform. It helps you understand the hidden vulnerabilities.
Right, prepares you for the worst case. Now, let's talk metrics. The Sharpe ratio, this comes up constantly. Why is it the gold standard?
Because it directly tackles that risk-reward trade-off we mentioned. It measures how much excess return you're getting for the extra volatility, the extra risk you're taking on, compared to a risk-free investment.
Excess return being?
Return above what you could get from something super safe, like a government T-bill. That's the risk-free rate.
Okay, so how's it calculated?
It's pretty straightforward conceptually. You take the portfolio's return, subtract the risk-free rate that gives you the excess return.
Got it.
Then you divide that number by the portfolio's standard deviation.
Standard deviation being the measure of its volatility, its up and down swings.
Exactly. It's the measure of risk in this context. So a higher Sharpe ratio is better, meaning you got more bang for your buck, essentially. More return for each unit of risk you took on. It lets you compare different investments or managers on an apples-to-apples risk-adjusted basis.
That makes a lot of sense. Okay, let's shift from practical metrics to fundamental theory. The capital asset pricing model, or CAPM.
Ah, CAPM, the bedrock of modern finance theory.
Still relevant, even though practitioners sometimes, debate its real-world accuracy.
Oh, absolutely still relevant, at least conceptually. CAPM provides the theoretical framework for understanding the relationship between systematic risk and expected return.
Systematic risk, that's the market risk you can't diversify away, right?
Exactly. Think of it like the tide. When the market goes up or down, it tends to affect most investments to some degree. CAPM tries to quantify that.
How? What does it try to calculate?
It tries to determine the theoretically appropriate required rate of return for an asset. What return should you demand, given its specific level of systematic risk?
Okay, so it's forward-looking, unlike Sharpe, which looks back at performance.
Right. Sharpe tells you what happened. CAPM tries to tell you what should happen or what return is fair compensation for the risk.
And how does it calculate that required return? What are the inputs?
3 key things. 1, the risk-free rate, or baseline again.
Okay.
2, the expected market risk premium. That's the extra return investors expect to get from investing in the overall market compared to the risk-free rate.
The reward for taking general market risk.
Precisely. And 3, the asset's beta.
Beta. That measures volatility relative to the market.
Exactly. Beta tells you how much an asset's price tends to move up or down when the overall market moves. A beta of 1 means it moves in line with the market. Beta of 2, it's theoretically twice as volatile. Beta less than 1, less volatile.
So CAPM uses these 3 to estimate the return needed to compensate for that specific asset's market risk.
That's the idea. It gives managers a theoretical benchmark. Is this stock priced to offer a return that fairly compensates for its beta, or is it over or underpriced relative to its systematic risk?
But here's the challenge, right? CAPM relies on estimates. Estimating the market risk premium, calculating beta based on past data. How reliable is it in the real messy world?
And that is precisely the friction. Academically, it's elegant. Practically, it's a guide, not gospel.
Right.
The quality of your inputs massively affects the output. Use garbage historical data for data. You get a garbage required return estimate. Markets change, correlations change.
So you have to use it with judgment.
Absolutely, which is why modern asset management isn't just theory. It needs the computational power to test these assumptions, run different scenarios, which brings us nicely to the technical toolkit.
Exactly. If EAPM is the theory, the tech toolkit is how you implement it, test it, scale it. Modern asset managers need serious quant skills now, starting with Python.
Python has become the workhorse for automation and data analysis in finance. It's essential for handling data at scale.
Oh, so give us an example.
Okay, take CAGR, compound annual growth rate. Calculating that for one stock by hand is easy. Calculating it accurately for, say, 2,000 funds in a portfolio universe.
Tedious. Prone to error.
Exactly. With Python libraries like Pandas, you can script that calculation to run across the entire data set in seconds. Final value, initial value, 1 years. 1. Plug in your data series, boom, done.
Allows for rapid screening, back testing.
All sorts of analysis that just wasn't feasible before. And it's not just calculation, it's getting the data in the first place.
Right, sourcing data.
We use libraries like requests to connect to financial data APIs, pull down streams of historical prices, economic data, whatever you need.
And then Pandas helps organize it.
Pandas is brilliant for that. It takes that raw data, structures it into data frames like smart spreadsheets, lets you clean it, handle missing values, calculate moving averages, volatility, correlations. It turns abstract financial concepts into practical computable steps.
Now, the sources mentioned more advanced use. Monte Carlo simulation. Sounds complex.
It's definitely a step up from just looking at historical averages.
But why? What problem does it solve?
The problem is that the past doesn't always predict the future. Relying only on historical returns can be dangerous, especially for risk management.
Because unexpected things happen. Black swans.
Precisely. Monte Carlo simulation, using libraries like NumPy for the math and Pandas for data handling, addresses this. It runs thousands, even millions, of randomized potential future scenarios for your portfolio.
Based on what?
Based on the historical volatility and correlations of the assets in your portfolio, but with randomness injected. It doesn't predict the future outcome.
But it gives you a range of possibilities.
Exactly. It generates a probability distribution of potential future returns and, crucially, potential drawdowns or losses. It helps you understand the likelihood of extreme events that might not be in your limited historical data. It tackles uncertainty head-on.
Very powerful for risk management. Okay, let's switch gears from modeling to data retrieval. SQL structured query language, still essential.
Absolutely essential. Financial firms run on massive databases holding client info, trades, asset details, performance data. SQL is the language you use to talk to those databases.
What are the key SQL skills an asset manager needs, beyond just pulling up a client's record?
It's about efficient aggregation and joining data. Sure, you need to find the top 5 performing assets, order by performance, DSC limit 5, that's basic.
Okay.
But the real value comes in things like performance attribution, calculating the average return grouped by asset class using group P by Y asset class and the AVG return function. That tells you where your performance came from. Equities, bonds.
And linking different pieces of information.
Critical. You need to join tables. For example, joining the asset performance table with a client information table using a join-on clause.
Why would you do that?
To answer questions like, what was the average return for only our clients based in California? Or what's the total value of assets held by clients with a high-risk tolerance profile? That requires linking data effectively.
Got it. Finally, the toolkit often includes R, what's its niche?
R's heritage is in statistics. While Python might be more dominant now for general programming and machine learning pipelines,
R is still king for scats.
For heavy-duty statistical modeling and specific financial econometrics, yes, it's still incredibly powerful and widely used. Asset managers might use R for complex time series analysis or calculating portfolio variance.
How does that work?
Well, for portfolio variance, you'd often use R's cov function to compute the covariance matrix of all the assets in your portfolio. That matrix is fundamental for portfolio optimization techniques.
Okay, we've covered theory, metrics, code. Now, let's bring it back to the real world. Managing actual money for actual clients. Let's start with something basic but vital. Liquidity.
Liquidity, so important, often overlooked until it's gone.
Define it for us simply.
It's the ease and speed with which you can sell an asset and convert it into cash without significantly impacting its price.
Cash is perfectly liquid. A house, not so much.
Exactly. And why is it important for an asset manager? It's about flexibility and stability.
How so?
High liquidity in a portfolio means the manager can react quickly. They can sell assets to rebalance, meet client redemption requests, cut losses on a bad position, or raise cash to jump on a new opportunity.
Without causing a fire sale.
Right. If you're forced to sell illiquid assets in a falling market, you might have to accept a terrible price, making losses even worse. That's a liquidity crisis.
Like we saw with some funds in 2008.
Precisely. So managing liquidity, making sure the portfolio has enough cash or easily sellable assets is a core risk management duty.
Okay, makes sense. Now let's talk clients. All the quant skills in the world don't matter if you can't manage the client relationship. What's key here?
Communication. Clear, honest, transparent communication is the absolute foundation.
Building trust.
Building and maintaining trust, yes. The sources really emphasize setting realistic expectations. Don't promise unrealistic returns. Explain the strategy, the analysis behind it, and crucially, the risks involved.
and tailoring the approach.
Absolutely critical. Asset allocation isn't one size fits all. You have to do a thorough assessment of each client's situation.
What goes into that assessment?
Their specific investment goals, retirement, buying a house, funding education, their time horizon, how long until they need the money, and very importantly, their tolerance for risk. How would they react emotionally and financially to a market drop?
And that profile dictates the investment mix.
It dictates the appropriate blend of equities, bonds, alternatives, everything. It has to be personalized.
And underpinning all of this, the analysis, the client interaction is ethics and regulation.
Non-negotiable. You're dealing with people's financial futures.
So what does that mean in practice?
It means, first, adhering strictly to all financial regulations, KYC, suitability rules, reporting requirements, and staying constantly updated because the rules change.
Compliance is key.
Absolutely. But ethics goes beyond just following the rules. It's about operating under a fiduciary standard.
Meaning
you must prioritize your client's best interests above your own or your firm's. Full stop.
So avoiding conflicts of interest.
Avoiding or clearly disclosing them. Maintaining transparency. Being honest even when the news is bad. Upholding confidentiality. It's about integrity.
Let's circle back to a theoretical concept that has huge real-world implications. Market efficiency. We touched on it earlier.
Right, the efficient market hypothesis, or EMH.
What does it state, basically?
In its most common forms, like the semi-strong form, it states that current asset prices already reflect all publicly available information. News, earnings reports, economic data, it's all baked into the price instantly.
So what's the big paradox this creates for active asset managers, the ones trying to beat the market?
The paradox is, if the market is efficient, then trying to find mispriced stocks based on public information is, well, largely futile.
Because there are no mispricings to find, or they're incredibly rare and fleeting.
Exactly. If prices already reflect all known info, then consistently picking winners or timing the market becomes incredibly difficult, maybe impossible over the long run, purely through skill.
Which challenges the whole value proposition of paying higher fees for active management.
It absolutely does. It suggests that achieving alpha might be more down to luck or taking on hidden risks rather than superior analysis of public data. It's a fundamental tension in the industry. Hashtag outtag outro.
Wow, okay. That was a seriously packed deep dive. We've hit the essential pillars of asset management.
We've covered a lot of ground.
Yeah, from core definitions, that active versus passive split.
Right, through the key quantitative tools, Sharpe ratio for performance, CAPM for expected return.
Then the technical toolkit, the importance of Python for modeling, SQL for data.
And R for the heavy stats, yeah.
And finally, bringing it back to the practicalities, liquidity management, ethical client relationships.
It really ties together. The comprehensive takeaway, I think, is that mastering this field requires integration.
How do you mean?
You can't just know the definitions. You have to use the financial metrics intelligently, leverage the tech tools to analyze and model uncertainty, and crucially, stay plugged into market trends and regulatory changes.
And never forget diversification and risk management.
Those remain absolutely paramount. Disciplined risk control is key.
Okay, so we'll leave you, our listener, with a final thought to chew on, building on that market efficiency idea. If the efficient market hypothesis holds even reasonably true, making consistent market-beating performance incredibly challenging.
Right.
And if low-cost passive funds keep gaining ground, does the primary enduring value of a traditional, often high-fee active asset manager need to shift?
Shift away from just stock picking.
Exactly. Maybe shift more towards becoming an expert financial advisor, focusing on things like behavioral coaching to stop you from panic selling, sophisticated tax planning, holistic wealth management, and providing that disciplined, personalized risk control that algorithms alone might miss.
Is the real value in the advice and discipline rather than the pursuit of elusive alpha?
Something for you to mull over. Thanks for joining us on The Deep Dive.